Well, hello, good evening, and welcome back to Rainbow Investing, where we examine a spectrum of ideas to improve your long-term wealth. Now, tonight we are going to talk about 2021, more specifically investing in 2021. Now, the year we're about to finish, 2020, has been an unprecedented year for a number of reasons. I don't think any of us, old or young, have ever invested in a year quite like this one. Now, with the pandemic and all, what we've seen in the stock market this year has been very dramatic, but also very strange. I'm going to explain why in a minute. Cast your minds back to March 2020. The stock market was in the throes of one of the worst bear markets we've ever seen. It was a very short but very sharp market crash. It was actually the shortest but sharpest market crash we've ever seen. But of course, that all feels like a distant memory now because the stock market has been making new all-time record highs of late. In fact, the Dow Jones only recently crossed the 30,000 point threshold for the first time in history. So all of us investors have actually been quite enjoying 2020, or at least the most part of it, because stocks have just been going up. But that's how it was at the start of the year too. If you remember January and half of February, you will remember the markets just going on a tear. But then of course the pandemic happened. Between 19th of February and the 23rd of March, the S&P 500 lost over 34% of its value. That's in just over a month. Now that was a very scary time to be invested because as we all thought at the time, if that amount of loss could be compressed into just 1 month, imagine what the next few months were going to be like. Well, the next few months happened and they were fantastic. Between the 23rd of March and the 30th of April, the S&P 500 gained 30%. So that's also just over a month. But of course it didn't stop there. Between the 23rd of March and today, the S&P 500 is up more than 62%. 62%. And remember, this is an index that typically delivers returns of roughly 10% per year, not just in the 8 months since the crash. So if you're finding this video useful so far, guys, I'd really appreciate it if you dropped a like just down below. It takes like 2 seconds and it really means the world to me. And it helps my channel grow in the very competitive finance space on YouTube. So I'd really appreciate it. Thank you. So anyone who bought stocks during that mid-late March period has done very well in their money for the most part. But here's where things get interesting. That doesn't normally happen in a share market crash. Think back to the last major share market crash we saw. That was during the global financial crisis back in 2008-2009. Now back then it took more than a year, so that's from October 2007 to March 2009 for the index to go from the top to the bottom. So over that time, the S&P 500 lost 56%. Can you imagine investing for a whole year, more than a year, only to watch shares go down? That is not what happened this year. If that had happened this year, we would still be looking at a falling index today. And I can assure you there would not be a lot of people excited about the share market right now. Now, just before we go any further, if you haven't already subscribed to my channel, I would really love if you could do so. So just hit that big red button down below and join our happy and growing family. In all seriousness, we talk stock market and personal finance all the time on my channel. So if that sounds like your cup of tea, we'd love to have you on board. Now, another sobering statistic for you. It took until March 2013 for the S&P 500 to get back to the level it was in October 2007. That is a very long 5 years to wait to get your money back. So what about the crash before that, the dot-com boom? Now, I personally wasn't old enough to be investing back then, and I'm sure most of you weren't either. But if you were, you might have remembered that from the peak of the dot-com boom, it took until 2007 to get back to those highs. And then of course the GFC happened just right around the corner. So that's 7 years of waiting to get back to the highs of the dot-com boom for the S&P 500. And then again you had to wait till 2013 to see them again. So this year has been different. But why? Why has this happened? Well, I've got 2 words for you: the Fed. See, in those 2 crashes, the Fed was a lot more restrained than they have been in this crash. In this crash, we have seen an unprecedented amount of money going into financial markets as a result of the pandemic. Have you seen this meme before? I bet you have. That is what's been happening. Just money coming out of nowhere and flowing into financial markets. That is likely the reason why we are seeing all-time highs right now, even though economies around the world are still very much in a deep recession. So that doesn't sound very optimistic. So what do we expect will happen in 2021? Well, I've been looking at it and I think there is no reason not to expect more of the same. See, the Fed hasn't stopped printing money. In fact, they've pretty much come out and said that they won't stop printing money until 2023. And they don't expect interest rates to rise from where they are right now, which is pretty much zero, until 2023. And that is contingent on inflation picking up. If inflation doesn't pick up, then I think we might even see interest rates stay at the current level for even longer. And that, friends, is good news for the stock market, because the same policies that are pushing it up in 2020 will continue until at least 2023. Now, whether this is good for investors in the long term is not what we're talking about here. But I think 2021, we will see more of the same money printing, more of the same near zero interest rates. And that is good news for the share market. So if you're waiting for the next market crash, I would strongly advise you not to do so. You can always use a dollar cost averaging strategy just to invest in simple index funds. But because interest rates are near zero, I just don't think anyone can afford not to be invested right now. Where are you going to have your money? In the bank earning 0.6%? It's just not viable. So if you're serious about building money, I would strongly suggest you look into the share market if you haven't already done so. Okay guys, that's all from me today. Thank you so much for watching. I really appreciate it, especially if you made it right to the end. Remember to hit that like and subscribe button if you haven't already. But before you go, how do you think 2021 will go in the share market? Are you investing? I would love to know. Please leave your thoughts and comments in the comment section below, and I'll get right back to you. I'll respond to every single comment. But that's all for now, guys. Thank you so much for watching. I'll be back with some more videos soon, but for now, good night.